Welcome to today's Explainer. We're going to tackle a fascinating conflict that sits right at the very heart of the financial world. It's this deep tension between our desperate, almost obsessive human desire to predict the future and the cold, hard mechanics of actually building wealth. We're pulling our insights today from the landmark analysis in Being Right or Making Money by Ned Davis. He's a guy who literally spent over 4 decades studying the market's true winners and losers, so there's a lot to unpack here.
So, let me ask you something. Would you rather be right or make money? Now, I know what you're thinking. It kind of seems like a trick question, doesn't it? Obviously, to make money, you have to be right about the market. But as we're about to see, the answer to this seemingly simple question fundamentally divides the absolute winners from the perpetual losers on Wall Street.
Okay, let's dive into this. There's this great old joke about a wealthy Texan who felt he wasn't very bright, so he goes to visit a doctor offering brain transplants. The doctor shows him the inventory: lawyer brains for $5 an ounce, doctor brains for $10 an ounce, and stock market guru brains for a staggering $250 an ounce. The Texan is just shocked and asks why the guru brains are so incredibly expensive, and the doctor replies, "Do you have any idea how many gurus it takes to get an ounce of brain?" People laugh, but it perfectly illustrates the massive premium our society places on supposed market experts, completely despite their actual track records. Section 1. The Forecasting Myth. Experts cannot predict tomorrow. Think about how the entire financial industry is practically built on the idea that successful investing relies on crystal ball predictions. But let's look at the hard data from the source material and systematically dismantle this widely held belief. What's truly glaring is this single number: 0%. Since 1970, there have been 7 distinct economic recessions. Do you know how many of those recessions the consensus of professional economic forecasters actually predicted beforehand? 0. Not a single one. Flipping a coin would literally produce a better economic forecasting record than relying on the consensus of the brightest minds in finance.
Well, you might be wondering, what about the Federal Reserve? I mean, they have unlimited resources, full professional staffs, total independence, right? But when tracking the Fed's own wide projection ranges for real GDP growth since the year 2000, the actual GDP landed within their projected target range a dismal 26.3% of the time. Even the ultimate insiders just can't predict the economy's trajectory with any reliable accuracy.
So, if the economists and the Fed can't do it, what about the legendary billionaire investors? Look at this admission from George Soros. He flat out states that his immense financial success stands in stark contrast to his ability to forecast events. He freely admits that all his forecasts are extremely tentative and subject to constant revision. His wealth, by his own admission, has absolutely nothing to do with having a perfect crystal ball.
And he's for sure not alone in this. Peter Lynch, one of the most successful mutual fund managers in history, takes it a step further. He advises investors to outright dismiss the entire forecasting industry. Nobody can predict interest rates, the economy, or the stock market. Relying on predictions is a fool's errand.
We'll cap off this reality check with a pretty blunt admission from former Federal Reserve Chairman Alan Greenspan. He said, "We really can't forecast all that well. We pretend we can, but we can't. The overwhelming evidence is clear. No one knows what tomorrow holds." If you're basing your financial security on being right about the future, you're really setting yourself up for failure.
Section 2. How winners actually invest. 4 keys to success. So if forecasting is essentially a myth, how do people actually get rich in the markets? Let's shift our focus from the frustration of expert failure to the actual solution. Ned Davis discovered that the methods of consistent market winners, regardless of their specific strategies, all basically boil down to simple lessons we learned in kindergarten. The absolutely crucial point is this: successful investors don't share a single magical trading formula, but they do share these 4 foundational principles. Whether they're long-term value investors like Warren Buffett or rapid-fire commodity traders, they all rely on objective indicators, discipline, flexibility, and risk management. Let's break these down one by one.
The first key is objective indicators. Think of this as the kindergarten lesson of learning what's real versus what's imaginary. The author shares this riddle. If a high-priced lawyer, a low-priced lawyer, and the tooth fairy are all in a room with a $100 bill and the lights go out, who takes the money when the lights come back on? The high-priced lawyer, of course, because the other two are figments of your imagination. Winners use mathematical metrics backed by historical analysis to ensure they're trading on factual reality, not the emotional imagination of the crowd.
And this brilliantly illustrates that exact concept. Looking at the S&P 500 mapped against the Consumer Price Index, we have a purely objective mathematical indicator. Historical analysis shows that when the year-to-year inflation rate sits at least half a percentage point below its 5-year average, the stock market historically jumps at a 13.5% annual rate. That is nearly double the regular buy-and-hold average. No gut feelings required, just objective math signaling a massive opportunity.
The second key is discipline. The greatest flaw most investors have, and by the way, the author totally admits this was his flaw too, is letting human ego and emotion color their market views. When your ego gets involved, it becomes almost impossible to admit you made a mistake. To combat this, winners rely on rigid systems, like computer-derived mathematical models, to force discipline upon themselves, and just filter out the noise of their own arrogance.
In kindergarten, we're warned that without rules, there will be chaos. The exact same applies to your portfolio. As market analyst Dan Sullivan noted, successful investors are like great athletes. They adhere to a strict discipline. Sticking patiently to an objective system, through both the good times and the bad, is what actually prevents the critical, emotionally driven mistakes that wipe out average investors. Let's move to the third key and see how this builds your defensive armor. Flexibility. This is essentially the childhood lesson of expecting surprises. Legendary investor Stan Druckenmiller famously made a massive error right before the 1987 stock crash, shifting to 130% long. But when the market opened and he realized the objective evidence had shifted against him, he didn't stubbornly hold on just to be right. He exhibited ultimate flexibility, liquidated his entire position in the first hour of trading, went short, and actually finished that catastrophic month with a net gain. Unbelievable.
Finally, we arrive at the fourth and undoubtedly the most important key, risk management. This mirrors the most basic childhood rule of all. Be careful. Legendary trader Paul Tudor Jones once said the very first thing he does every single day is try to figure out what's going to go wrong so he can protect himself. Winners focus primarily on controlling their losses rather than just blindly pursuing profits.
To really drive this home, listen to this quote from Leo Melamed, Chairman Emeritus of the Chicago Mercantile Exchange. He figured out that through strict money management, he could actually be wrong 60% of the time and still come out a big winner. How? Because he ruthlessly cut his losses short while letting his profitable trades run. You literally don't need to be a perfect forecaster if your losses are kept mathematically tiny.
And that brings us to an absolute mic drop quote summarizing this entire philosophy, attributed to the legendary Jesse Livermore. A loss never bothers me, but being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. The ultimate difference between a stubborn, failing forecaster and a wealthy, successful risk manager is just the ability to swallow your pride, admit a mistake, and exit a bad position immediately.
Which brings us right back to where we started. So really ask yourself, are you investing to prove how smart you are? Are you searching for gurus to predict a future that simply cannot be known? Or are you willing to use objective indicators, strict discipline, total flexibility, and ruthless risk management to actually build wealth? Are you trying to be right, or are you trying to make money? Take that thought with you the next time you look at your portfolio. Thank you so much for joining me for this explainer, and keep learning.